Silicon Valley Bank, the go-to bank for the tech industry, went out of business after a bank run. Mass cuts in late 2022 and early 2023 were the first news about the hard-hit tech industry. This bank failure is the biggest since Washington Mutual in 2008, and it's another setback for the tech business. The US government came in to protect customer deposits, and HSBC plans to buy Silicon Valley Bank's UK branch. Here's what happened to Silicon Valley banks and how it might affect tech companies and startups in the future. What is Silicon Valley Bank? Silicon Valley Bank was founded in 1983, and before its demise, it ranked as the 16th largest bank in the United States. They were experts in financing and banking for startups backed by venture capital, most of which were technology companies. Venture capital companies and tech executives all did business there. The Federal Deposit Insurance Corporation reports that at the end of 2022, Silicon Valley banks had $209 billion in assets. Why did SVB matter to the tech industry? About half of the venture-backed technology and healthcare companies in the US got money from Silicon Valley banks. Silicon Valley Bank was a popular bank in the tech industry because it worked with startups, which not all banks would work with because they are riskier. In 2020, people spent a lot of money on digital services and electronics during the pandemic. Tech companies got a lot of money and needed Silicon Valley Bank's services to hold their money for business costs like payroll. Most of these savings were put into investments, which is what banks usually do. Why did it collapse? The collapse happened for several reasons, including a lack of diversification and a standard bank run, in which many customers withdrew their money simultaneously out of fear that the bank wouldn't be able to pay them back. Many of Silicon Valley Bank's investors were new businesses. According to Jay Jung, founder and managing partner of Embark Advisors, investors handed them a lot of money because the technology was in high demand during the pandemic. Lack of diversification. Silicon Valley Bank invested a lot of bank savings into long-term US treasuries and agency mortgage-backed securities. But when interest rates go up, bond and treasury prices go down. Silicon Valley Bank's bond holdings began to decline when the Federal Reserve boosted interest rates in 2022 to combat inflation. It would have gotten its money back if Silicon Valley banks had held on to those bonds until they were paid off. Silicon Valley Bank used to give money for short period, but in 2021, they switched to long-term stocks like treasuries for more yield, and they didn't protect their liabilities with short-term investments that could be sold quickly. They were broke for a long time because they couldn't sell their assets without losing much money. When the economy hurt the tech industry, many bank users took money out of their accounts and venture capital dried up. Because these deposits were tied to long-term assets, Silicon Valley banks needed more cash to cash them out. They started selling their bonds at a big loss, which upset buyers and investors. The bank failed just 48 hours after the sale of assets became public. Bank run. When Silicon Valley Bank said on March 6 that it was collecting $1.75 billion in the capital, people worried that the bank didn't have enough money. Twitter and WhatsApp quickly spread the news that the bank didn't have enough money, which caused fear. People started to get their money out in waves. After Silicon Valley Bank announced that it was collecting money, its stock dropped by 60% on March 7. Some people say that Twitter caused the bank run. On March 8, officials in California shut down the bank and turned it over to the Silicon Valley Bank's clients had much bigger accounts than people who did personal banking. During the bank run, it took only a short time for people to take out more and more money, which caused a snowball effect. Most customers had deposits that were more than the cap of $250,000. Many startups left money in their Silicon Valley Bank's primary account instead of using other funds, like a money market, to pay for expenses. This means that most of their working money was in their Silicon Valley Bank's account, and they needed access to their deposits to pay payroll and bills. Who is affected by the collapse? A significant loss was incurred by Silicon Valley Bank's owners and investors since, in contrast to customers, their investments were not protected by the Federal Deposit Insurance Corporation. One such problem is that more funds need to come in from deposits to cover immediate costs like salaries. Etsy, Roblox, Rocket Labs, and Roku are large technology companies with significant cash reserves in Silicon Valley Bank. The Federal Deposit Insurance Corporation insurance protects most banks. Despite this, the accounts were only insured up to a maximum of $250,000. This is a little when dealing with company accounts because they may spend millions in a single month. First Citizens Bank purchases Silicon Valley Bank. The Federal Deposit Insurance Corporation said on March 26, 2023, First Citizens Bank would buy Silicon Valley Bank and take over most of its savings and loans. As of March 10, Silicon Valley Bank had total assets of nearly $167 billion and savings of $199 billion. At a discount rate of $16.5 billion, First Citizens Bank will buy assets worth about $72 billion. FDIC will keep control of assets and stocks worth nearly $90 billion in its receivership. Silicon Valley Bank, a division of First Citizens Bank, will run all 17 offices of Silicon Valley Bank. The Federal Deposit Insurance Corporation also thought the loss of Silicon Valley banks would cost almost $20 billion. More bank issues. Signature Bank and Credit Suisse needed help staying solvent, along with Silicon Valley Bank. In a deal brokered by the government on March 19, Union Bank of Switzerland decided to buy Credit Suisse for 3 billion Swiss francs, or $3.25 billion. The Federal Deposit Insurance Corporation says that on March 19, New York Community Bank decided to buy a big part of Signature Bank in a deal worth $2.7 billion. Flagstar Bank, a New York Community Bank subsidiary, will take over the offices of Signature Bank. On March 14, Moody's Investor Service put Comerica Bank, First Republic Bank, Intrust Financial, Upper Mink Brook Financial, Western Alliance Bank Corporation, and Zions Corp. on review for credit rating downgrades. High unrealized losses and many deposits that the Federal Deposit Insurance Corporation doesn't cover are some of the reasons for these scores. These are also problems that affected Silicon Valley banks. What is the Federal Reserve doing? Silicon Valley banks will not get help from the government. It will stay bankrupt, and the left goods will be given to creditors. If another bank buys it, a buyer can bring it back to life. On March 12, the government promised that all payments at Silicon Valley banks would be covered, but shareholders and unsecured creditors are not covered by this promise. Since Silicon Valley Bank closed, the Federal Deposit Insurance Corporation created the Deposit Insurance National Bank of Santa Clara to combine protected and uninsured deposits into one bank. All savings at SVB were moved to the National Bank of Santa Clara, and insured depositors could access their money on March 13. The Federal Deposit Insurance Corporation will pay early dividends to savers who are not covered by insurance. They will get a ticket with the number of their uninsured funds that will allow them to get the rest of their money when the Federal Deposit Insurance Corporation sells the assets of Silicon Valley banks. The Federal Reserve may be less likely to raise interest rates if bank stocks are unstable. The bigger banks are well protected and diversified, but regional banks may feel the tightening of the market if they have ties to businesses that tend to be short on cash, like tech startups. The Federal Deposit Insurance Corporation will generally sell the assets of a failed bank to someone else. The money from these sales will be used to pay back depositors who weren't protected. The company that used to own Silicon Valley Bank, Silicon Valley Bank Financial Group, filed for Chapter 11 bankruptcy on March 17. Silicon Valley Bank shareholders had gone after Silicon Valley Bank Financial Group in a civil case. Administrators will sell assets to pay off claims made by creditors. The Federal Deposit Insurance Corporation is in charge of Silicon Valley Bank, so they're not part of this bankruptcy case. Silicon Valley Bank's bankruptcy shocked the financial business. As a trusted institution, its failure is a stark reminder of how important it is to keep finances stable and control risks in a market where things can change quickly. Even though it's a hard time for those affected by the bank's closing, It's also a chance for the industry to think about how to stop similar things from happening. In the end, the lessons learned from the failure of Silicon Valley Bank will shape the direction of the financial industry for years to come. If you liked this video, please give it thumbs up and remember to subscribe to our channel to see more videos like this one. And as always, thanks for watching.